This is Macro Horizons, episode 355. Dear 2025, thanks for the memories. Presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of December 22nd. The holidays have arrived, as has the winter solstice. The days are only going to get longer from here. Just let the sun shine in. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the BLS backfilled some of the key missing data points that had occurred as a function of the government shutdown. The two obvious highlights were payrolls for October and November, as well as the CPI series for November. In terms of the employment landscape, what we learned was that in October, non-farm payrolls declined by 105,000, and in November, we saw a rebound of 64,000, which was higher than expected. The October numbers were distorted by federal employees who took buyout deals earlier in the year and finally came off of the federal payrolls at the end of September. That accounted for 162,000 fewer people on the payrolls. So putting the data in that context suggests a continuation of the holding pattern that has been evident in the U.S. employment market. The unemployment rate increased to 4.6%, which is the highest since 2021, and we saw underperformance in average hourly earnings for the month of November at 0.1%. This brought the year-over-year pace of nominal wage inflation back into the range that defined the pre-pandemic period. So, on net, we're comfortable with the characterization of the employment data as being consistent with the market's interpretation of the state of affairs prior to the government shutdown. It's also notable that, as expected, the BLS offered a few caveats in terms of the data collection period and the implied quality of the October and November series. The key takeaway being that the market will await the December data in the middle of January before developing a high-conviction view about whether or not the Fed will cut another 25 basis points at the January meeting. In terms of inflation, CPI surprised on the downside, and frankly, pretty dramatically so. The 2-month change of inflation between September and November was only 0.159. So that means that the average monthly change was 0.08. Now, there are a lot of caveats to be added here, specifically that some of the changes in OER and the rent components seem to imply that the BLS just marked those as zero or close to zero for the month of October, which then subsequently skewed all of the inflation numbers lower. For context, the year-over-year CPI print came in at just 2.7%, and core CPI underperformed expectations at 2.6%. So while it is tempting to suggest that these numbers clear the way for the Fed to cut in January in the event that the employment data justifies such a move, at the end of the day, we, and most market participants, are skeptical that inflation was, in fact, as low as the BLS says it was in October and November. As a result, and consistent with our approach to payrolls, we'll wait until mid-January's publication of the December series before having a strong opinion about what should be anticipated from the Fed during its first meeting of 2026.
Well, admittedly, there's been some surprises and creative solutions offered in the monetary policy realm over the course of the past several decades, but Ian, I think you and I will both agree that this particular way of getting closer to the 2% inflation target was not really on our radar.
I think that is fair to say, although before we render too much judgment on the BLS, they were in a difficult spot. they had to attempt to backfill the NSA series for October in a way that was simply deep into uncharted waters. And the reality is that market participants were not in the room where it happened, nor do we have the full context precisely for the discussion that ended with an average core CPI print for October and November at just 0.08%. At the end of the day, I expect that investors are heavily discounting both the CPI as well, frankly, as the payrolls report, and will look towards the middle of January when we have data collected in the typical fashion in hand and are able to better calibrate the risks as we go into the January FOMC meeting.
And it wasn't just the CPI report, even before taking into account the distortions that made the data very difficult to interpret for what it actually meant for the path of inflation over the last 2 months. We got November's payrolls report as well, and while the jobs numbers had their own issues relating to the government shutdown and the timing of data collection around the Thanksgiving holiday, nonetheless, what we saw was a modest upside surprise in terms of headline hiring, but an increase in the unemployment rate that was partially a function of a higher participation rate. And in aggregate, the employment figures reinforced what we heard from Powell at the December press conference and what we've heard from other Fed speakers, some of whom are in contention to be the next Fed chair, as it relates to worries on hiring, continuing to outweigh concerns that an inflationary reacceleration is going to mean that we're not going to get a rate cut in the first quarter of next year. Clearly, the Fed, even the Powell Fed, is still of the opinion that looking forward, the distribution of risks around the jobs market still favor a less restrictive monetary policy stance, and even once Powell's term is up and we have a new Fed chair, we're expecting that that bias will persist. So what this has translated to is less of a compelling move in outright yield terms. After all, 10s have remained very well contained between 4% and 4.25, and instead the most notable price action has come via the impressive steepening of the curve. The data has cemented more Fed cuts, even in the face of the economy that is doing good, if not great, with what that potentially means for upside inflation risks that will go unaddressed by tighter monetary policy. And this is all pointing toward a 2026 that we expect will still be characterized by a slow, steady grind steeper in the yield curve, as investors, and the Fed, prefer owning the front end as opposed to the long end of the curve, given inflationary worries and supply concerns. So that means our generally bullish outlook on treasuries for 2026 is most acute in the 2-year sector.
And I think that that's a fair characterization of our thinking in general, not only for the course of the next several months, but also for 2026 as a whole and into 2027. During 2025, the curve steepener was a popular and crowded trade, and while the curve ultimately did steepen over the course of the year, it certainly didn't steepen as much as many had anticipated. As we see 2s 10s peaking at nearly 70 basis points, our outlook for next year suggests that while there is more to come, it's going to be largely a function of a rally in the 2-year sector as we move forward and the Fed realizes more rate cuts and the market then subsequently prices in a lower terminal rate. Now, for context, the futures market still has Fed funds ending next year at a range of 3 to 325. That's not a great deal of further normalization, given that the current upper bound is at 375. And of course, as is often the case, the wild card comes in the form of how will the real economy and the Fed perform versus expectations. And at this current moment, we'll argue that the economic outlook and the Fed's response are particularly optimistic, especially in the context of how the real economy apparently performed during the government shutdown. Of course, we are skeptical of the BLS data because of all the noise related to the government shutdown, but as a departure point for the conversation and a 4.6% unemployment rate, the highest since September 2021, it's difficult not to at least have a low level of anxiety as it relates to the labor market in the year ahead.
And another one of the big questions in 2026 will be how risk assets perform, which in no small part will be a function of how valuations around some big-name AI companies and chip manufacturers persist or don't as the cycle continues to play out. Now, being bearish on domestic equities has not proven an especially fruitful strategy over the past several years, and frankly, given the monetary policy backdrop, but also the fiscal support that will benefit the real economy next year, it's not unreasonable to expect maybe some rationalization in the AI space in terms of valuations, and that will have an impact on broader equity indices. but frankly with a labor market that is cooling but by no means collapsing, and a wage growth picture, again, that is not awesome, but also not horrible, it's not unreasonable to expect that whether a result of cost-cutting measures and layoffs or an easier interest rate backdrop, that corporate America will continue to be able to perform during next year. And so while it might not be a record year for stocks, it doesn't seem that there's a great deal of concern that a sharp tightening in financial conditions as a result of an equity vol spike is going to be the catalyst for a broader rethink of the macro backdrop.
One obvious concern that we have as we think about the year ahead is the degree to which the midterm election changes the behavior of the administration. Now, we're going into the midterms assuming that the Democrats take either the House or the Senate, and we end up with a divided government. This is very consistent with the political winds as well as a typical outcome during the second half of a given president's presidency. What one would typically think is, as a two-term president faces the last 2 years of his or her presidency with a divided Congress, they would effectively slip into the category of a lame duck or be a placeholder for the next administration. That would typically be characterized by no major initiatives on the legislative front and by a decrease in regulatory changes. Now, that's a typical environment. Given the current administration's behavior thus far, it wouldn't be surprising to see, when faced with a divided Congress, the administration tries to further expand the power of the executive branch. Now, whether that translates through to more executive orders and whether or not there's a concerted effort on the part of the Supreme Court to limit some of the powers of the executive branch all remains to be seen. But if nothing else, this represents a wild card that could find an expression in the equity market and therefore tighten financial conditions and, perhaps more importantly, undermine the wealth effect and thereby cool both inflation and the real economy.
And away from the labor market and inflation, and frankly relevant ahead of the new year, is going to be the funding market. Reserve management purchases are underway, and the Fed stands ready to take additional action, if needed, to contain any money market volatility now that the level of reserves have dropped to a level that the Fed deemed action was warranted. And so, as we look beyond year-end and what will probably be some upward pressure on SOFR, but that's more or less typical around calendar dates such as the end of the year, we expect that what we'll see is a gradual increase in SOMA's participation in the secondary market. After all, the groundwork has been laid for up to 3-year notes to be purchased in the name of maintaining reserves. And so as the balance sheet continues to grow, we don't expect that concerns around a funding blow-up will be nearly as pressing as they were over this past year. We also have the rebrand of the SRF in the New York Fed's attempt to destigmatize the program. It remains to be seen how successful that is or is not, but clearly the Fed's shadow third mandate in terms of maintaining orderly market function, critically money market function, remains intact, and especially given the increased what we'll call coordination between the executive branch and the FOMC, it's not unreasonable to assume that Besant's issuance plans are going to more or less line up with what it is that the Fed is doing in terms of secondary market purchases. It might not be MMT, but it's maybe Besant's MT?
One thing we can conclude with a reasonable amount of confidence is that the Treasury Secretary has been successful in helping the Fed find a path to monetizing the deficit, at least for the time being. And frankly, one would expect that that should have implications for the U.S. dollar. And as we've seen, the U.S. dollar certainly has been trending weaker, as a theme at least. And we struggle to imagine, given all of the cross-currents, that there's a strong dollar bullish story ahead, although continuing to consolidate in the well-established range does seem to be the path of least resistance at the moment.
And regardless of what happens with the dollar, the price will always be right for macro horizons.
355 times. And counting.
Very good and very cheap.
In the week ahead, the market will be focused on the fact that, in practical terms, it's really just half a week. Thursday will be a complete market closure for Christmas Day, and Wednesday, SIFMA has recommended an early close. Now, while the market is officially open on Friday, we anticipate low attendance, to put it mildly. On the data front, we do have a couple reports early in the week worth highlighting. First, we have the ADP weekly series that comes out on Tuesday. This data will continue to provide yet another real-time, or close to it, measure for the employment market. Recall that the prior print from this series showed an improvement, which contributed to the broader sense of stabilization in the labor market. Now, the verdict is certainly still out on whether this continues into the new year, but for the time being, the realized economic data has only further reinforced our range trading thesis, particularly in the longer end of the curve, as 2-year yields remain wedded to monetary policy expectations, and 10-year yields appear content to trade between 4% and 4.20. Our expectations are for that range to hold into the new year and that there will be a steepening bias in the curve as we grind forward to the first full week of January. The week ahead also contains a few notable Treasury auctions, including 69 billion 2 years, 70 billion 5 years, and 44 billion 7 years. Again, in the context of thin markets and limited attendance, while we're confident that there will be adequate sponsorship to underwrite these issues, even the perception of softer auction takedowns will be easily dismissed in the context of limited liquidity. On Tuesday, we'll get the Conference Board consumer confidence figures. While typically this report isn't a market-moving event in the traditional sense, given a lot of the cross-currents and the ongoing concern that there's more weakness in the labor market than the official BLS data suggest, we'll be closely watching the labor differential component within this series for any indication of a weaker jobs outlook for the month of December. And as has been the case recently, the focus on the global rate environment is likely to continue. And we've been characterizing the backup in JGB yields, for example, as more of a headwind to keep 10-year yields from going below 4%, rather than a harbinger of a fresh round of bond bearishness that would get 10-year yields back above 4.25. So in this context, we'll be very interested to see the interplay between U.S. rates and other major sovereign borrowing costs, as well, of course, how the equity market rounds out 2025, especially in light of the recent choppy price action, as well as the forward implications for the wealth effect and what that could mean for the state of the consumer. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as this will be the last Macro Horizons episode of 2025, we'd like to wish everyone happy holidays and best of luck in the new year. Thanks for listening, and don't worry, we'll be back during the first full week of January. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.